The noise in a trading pit during a sell-off is the sound of thousands of individual investors losing their nerve at once. This is the visceral reality of a market driven by panic. If markets operated on cold, mathematical logic, prices would be entirely predictable. Yet valuations frequently drop on positive earnings reports and surge on terrible news. This disconnect happens because every single price movement is fueled by a collective struggle between fear and greed. Following a rational investment policy in an irrational world is usually a guarantee for disaster. To measure that chaos, we have to look back to 18th century Osaka. Inside the Dojima rice exchange, a merchant named Munehisa Homa spent years watching the behavior of the crowd in this courtyard. Homa realized that the psychological state of those merchants influenced the price of rice just as heavily as the actual physical crop yields. He developed a system to track this mass psychology over time, a framework we now know as the Japanese candlestick chart. The same method used to map the anxieties of feudal rice merchants is now used to decode the volatility of modern global digital markets. A single candlestick is a box that contains one trading session's psychological battle. The central rectangle is drawn directly between the session's open and close. We call this the real body. It shows who won the day's fight between the buyers and the sellers. The thin lines extending from the top and bottom are the shadows or wicks. These record the intraday panic or exuberance that pushed prices to extremes before the market retreated. In a doji pattern, that real body shrinks to a flat horizontal line. It indicates a perfect stalemate, where the opening and closing prices end up identical. Every pattern on a chart serves as a physical archive of how a crowd of traders responded to pressure over the last 24 hours. Certain shapes act as warning signs for shifts in market psychology. A candle with a tiny upper body and a disproportionately long lower wick tells a specific story. During this session, the market panicked and prices plummeted. But by the close, buyers fought back fiercely and drove the price back to the top of the range. At the bottom of a downward trend, this is a hammer, indicating a potential floor. But if this same shape appears at the top of a rally, it's a hanging man, signaling that the move is exhausted. Then there is the engulfing pattern. It starts with a small candle, immediately followed by a massive candle in the opposite color that completely swallows the height of the first. This represents total psychological dominance. One emotion, like greed, has completely consumed the previous fear, signaling a reversal in the trend. Identifying these narratives allows a trader to anticipate a change in direction before the economic headlines even catch up. Reading the market psychology is useless if you cannot control your own. Anxious traders frequently fall victim to confirmation bias. They stare at the screen and only recognize the bullish patterns they desperately want to see. When the fear of missing out takes over, the urge to follow the crowd overrides the clear warnings the candlesticks are providing. The chart patterns rarely fail. It is the human interpreting them that often breaks down under the pressure of the trade. The philosopher Jim Rohn taught that personal discipline is the only way to survive this kind of emotional chaos. He left a clear warning. We must all suffer one of two things: the pain of discipline or the pain of regret. A candlestick chart is just a map of where the wind has blown. You remain responsible for how you set your own sails. By identifying the anatomy of panic and greed, you stop reacting to the market's volatility and start responding with your own plan.